You've probably heard some finance bros say, just throw your money in index funds and chill. But what is an index fund? Is it a fund of indexes? And more importantly, why is everyone saying it's the key to getting rich slowly? Let's break it down without the Wall Street word salad. Welcome to Normal People Finance, the no BS money channel for everyone who's felt left out of the finance conversation. We're not selling courses. We're not pretending you're dumb. We're just here to help you understand how money really works. So if you like honest advice with no hype, hit that like button and subscribe. Now, let's talk index funds. Imagine you walk into a grocery store. You could buy every single ingredient to make a peanut butter and jelly sandwich from scratch, or you could just buy the sandwich. An index fund is the pre-made PB&J of investing. It's a bundle of lots of companies' stocks, all in one tidy package. Instead of trying to pick the best stock like Apple or Tesla, an index fund buys a whole bunch at once. But here's the magic. Index funds don't just buy random stocks. They mirror a specific index, like the S&P 500. The S&P 500 is like a greatest hits playlist of the 500 biggest companies in America. Think Amazon, Microsoft, Coca-Cola, and Netflix. So, when you invest in an S&P 500 index fund, you're not buying one company. You're buying a slice of all 500. No guesswork, no day trading, just vibes. Here's what's wild. Most professional investors, the kind in suits and glass offices, can't even beat the market long term. Yet index funds are the market. They're designed to match the market average, not beat it. And guess what? That simple strategy has crushed most hedge funds and hotshot stock pickers over time. Even Warren Buffett, literal billionaire, said most people should just buy an S&P 500 index fund and keep adding to it. Why? Low cost. Index funds don't need expensive managers. That means fewer fees eating your returns. Diversification. One fund gives you exposure to hundreds of companies. Long-term growth. Over the last 50 years, the S&P 500 has averaged about 10% annually. Past performance isn't a guarantee, but it's a solid track record. Let's bust a few myths. Index funds are not a get-rich-quick scheme. They're slow, steady, and boring, and in a good way. They're not the same as mutual funds or ETFs, but there's overlap. An ETF, exchange-traded fund, is a type of index fund you can trade like a stock. A mutual fund can be actively managed, more expensive, or passive like an index fund. They don't guarantee profits. Index funds can go down, like during market crashes, but historically they've gone back up and up over time. So if someone promises you guaranteed returns, run. They're either lying or selling you a course. Okay, so how do you buy an index fund? It's way easier than most people think. You don't need a broker or a suit. You just need a free investing app or platform. Here's the simple process. Pick a brokerage. Think Vanguard, Fidelity, Schwab, or apps like SoFi, M1 Finance, or Robinhood. Search for an index fund. Look for tickers like VOO, SPY, or FXAIX. Total market funds. Try VTI or FZROX. Dividend-focused funds. Something like SCHD. Buy it like a stock. You can start with as little as $5 on most platforms. Set up auto investing. Seriously, automation is your friend. You don't need to day trade. You don't need to watch the news. Just set it, forget it, and let compounding do its thing. You might be thinking, yeah, but what if everything tanks? Like 2008 or COVID? Totally fair question. Here's the truth. Markets crash all the time, but they've always recovered and often stronger than before. The key is time. If you invest for 20, 30, 40 years, those dips become speed bumps. Imagine investing $100 per month into an S&P 500 fund for 30 years. At a modest 8% average return, you'd end up with over $135,000. And you only put in $36,000. But only if you stay invested. Panic selling is where most people go wrong. Don't be most people. Index funds are bundles of stocks that mirror major market indexes like the S&P 500. They're loved for being cheap, diversified, and effective. No stock picking needed. Buying them is easy through any investing app. Start with $5 or $50, no big upfront cost. They're not fast money, but they're historically one of the safest long-term bets. Set it, forget it, and don't panic during market dips. That's how compounding works its magic. If this episode made index funds feel a little less intimidating, hit that like button and subscribe. We drop new videos every week to help normal people, not finance bros, take control of their money. And next up, we're tackling the sneaky ways banks profit off your laziness. You're gonna want to see that.